This is Mike Larson, your MoneyShow MoneyMasters Podcast host. This week's episode features two segments recorded from the floor of our just completed 2023 MoneyShow TradersEXPO conference in Orlando. First up is my interview with Lindsey Bell, Chief Strategist at 248 Ventures and CNBC contributor. Then, guest host Jeff Hirsch, Editor-in-Chief of the Stock Traders Almanac, and Barry Ritholtz, Founder and Chief Investment Officer at Ritholtz Wealth Management. I hope you enjoy this special episode. Let's talk a little bit about what it is that 248 Ventures does. Like, what are you trying to do with this business here?
Yes, so right now I create insights and market strategies for institutional clients, advisors, and high net worth individuals. So it's really just helping people understand the markets and figuring out what to do with their money from there.
Got it. Now, I know at an event like this, I think you're talking about a couple different things. One of it is alternative investing and so on. What are you looking to convey to investors that are here at the Money Show?
Well, what my message today is that while the bears have taken hold of the market, over the last several weeks, what I would say, actually several months since the beginning of August, my message is that there still is that opportunity for that end of year Santa Claus rally, and even a rally into the beginning of next year. And the reason for that is the strength of the consumer. I think the risk right now that a lot of people are concerned about is, when is this recession that we've been waiting over a year for, when is it going to come? And it's got to come in 2024. Yeah. Even if we do get a slowdown or even a mild recession in 2024, I think the consumer and corporations are going to be able to chug along just fine to get us through that period of time. And I think the market can do pretty well, and this pullback that we're currently going through could be a gift into the end of the year.
What's interesting, you mentioned the recession thing. I know a year ago there's that famous Bloomberg headline, 100% chance of recession I think we're going to have, and that obviously didn't pan out. We had 4.9% GDP. Why do you think there's so much concern out there when the data has consistently kind of come in okay to good?
Yeah, I mean, it's been an untrusted rally all year. We're still up 15, 16% since the October low of last year, even with the drawdown that we've recently had. I think that for people, we're late cycle, okay? The Fed is almost done raising rates. Maybe they are done raising rates. Maybe July was the last one, to be determined. There's, at this point in time, as the recording of this, there's a 25% chance of a rate increase in December. But the point is they're almost done, which means that once they're done, there's only a period of time before they start cutting rates, and then they cut rates because things are slowing drastically enough that we're probably going into a recession. So that's where the soft landing comes off the table. So a pause in Fed increases is actually a good thing for the market. The market can do well for up to 13 months after that. It's just when they start cutting, which is the part that I get confused about, because a lot of people are like, the Fed needs to cut, rates are too high. But if they're cutting for a reason the majority of the time. So I'd rather us sit and wait and see how the economy absorbs these high interest rates. If so far so good, that doesn't mean it can last forever. But I think that for the next 3 to 6 to 8 months potentially, we should be able to see the market continue to move gradually higher.
Got it. So we've dealt with two of the major concerns that always get brought up: recession risk and interest rates. What about some of the other things that impacting markets? Earnings. I mean, what have you seen in the Q3 numbers, and what do you think you're looking for over the next couple of quarters? Is that going to be a net positive, negative, something maybe in between?
Yeah, I mean, I think earnings are kind of getting lost in the mix. We obviously have a lot of geopolitical issues that are happening right now, and I think that's actually weighing more on markets than interest rates are right now. Yeah. But earnings season overall has actually been a really good period. And I said this the last 2 quarters, I continue to say it going into the third quarter. Don't listen to what CEOs and CFOs say. Watch what the numbers do. Yeah. And the numbers have been coming in better than expected. Of course, CEOs and CFOs in the current environment have every reason to take a cautionary stance at this point in time. But I think what you're going to continue to see is that margin expansion has returned from those post-pandemic lows as supply chain pressures have eased, as the cost to ship things has gone down dramatically. So the supply chain and cost of raw materials and things like that have improved. And as we saw most recently from McDonald's, raising prices on their goods has allowed margin expansion to continue as the costs come down, prices continue going up. That is the price situation is definitely coming under control. So we could talk about inflation too, but because margins are going to continue to expand, I think earnings can continue to do well. They're going to be about flat for this year, for 2023. And we're expecting so far to see an 11-12% increase in earnings in 2024, which would be a return to a little more.
Sounds like a pretty decent number. Yeah, it sounds like a pretty decent number because we had, 3 or 4 quarters where earnings were negative year over year, and we've come out of that. So.
Right, and the third quarter is, so far, it's going to be the first quarter that we've seen positive earnings growth in the last 4.
How much stock do you put in things like, some of the other speakers I've listened to talk about seasonality and, the markets tend to be fairly strong in this sort of point in the presidential cycle. I'm wondering if that ever factors into when you look at markets.
No, I believe in it. It's not this like voodoo that is out there. It's a real thing. I also worked with Sam Stovall previously. And
he's one of those people I've heard from.
He's one of those that is a big believer in seasonality, and I believe in it as well. These trends are based on several decades of historical data. And so I think that it is true that we are going into the strong period of the year. And I think that we could see that unfold just that way. I mean, I think maybe the bears clutched on to the seasonal weakness in September and October, but hopefully the bulls can clutch on to it in November and December.
We've got 2 months left to see what happens for the rest of 23. Yes. Now, let me ask you this. If that scenario that you kind of have your base case, where would an investor be best served looking in terms of sectors, assets? I mean, what's the best opportunity if that plays out?
So when I'm looking at the equity markets, where I see the most opportunity is actually not the most, but some opportunity right now, especially given the recent drawdown, is technology. Okay. So multiples have come down to 24 times. Still a little rich by historical standards, but on a PEG basis, PE to growth, we've seen that multiple drop precipitously because earnings growth estimates have increased. So it's one of the few sectors that we're actually seeing that in. And while the stock market didn't react so well to some of the good earnings out of the big tech names in the past week or so, I see that as an opportunity to buy in if you haven't been there yet. I think there's going to be limited selling into the end of the year as hedge funds they're going to want to hold, and institutional investors are going to want to hold on to their winners through the end of the year and avoid those big tax bills. Got it.
And now I know that you're doing some other things in addition to being a CNBC contributor, talking about markets and so on. Why don't you talk a little about the Shift newsletter you're working on?
Yeah, so it's this new newsletter that I started in September. It's called The Shift. Okay. And what I'm trying to do there is get people to think differently about the workforce and the workplace as well as their money. I'm not necessarily telling you what to do with your job or your money, but I want you to think about things a little bit differently because maybe the status quo has been put to the test over the last couple years. And I try to link it to data to point to why things have changed over the last couple years. So if anyone wants to subscribe, it's www.lindseybell.me. It's a free newsletter. I put it out every Friday morning. So just try to get your brain moving a little bit on some different things.
Excellent. Hey, we've got presenters here at these events to talk about all kinds of different angles of the financial world. So that's wonderful advice. Lindsey, thank you so much here for joining me. Hope to see you at a future show.
Absolutely. Thank you.
Now it's time for the second half of this week's podcast, Jeff's interview with Barry from Orlando.
You think this high interest rate regime is going to last for a long time?
I will tell you something that most people won't tell you. I haven't the slightest idea how long this is going to last for. And that's because I don't know. The difference between me and them is I'm willing to tell you I don't know. They don't know either, but you don't get to go on TV if you say I don't know. And I talked in here today about higher probability wealth management. I don't think we go back to zero anytime soon. I think that was an unusual set of circumstances that came about following September 11th, the dot-com crash, and then the financial crisis. But I also think 5.5%, 6%.
It's pretty much historically normal.
It's average. However, we're in the 40th year of deflation as the dominant trend, with occasional spasms of inflation.
We had all the inflation in like 2 years that you normally get over a decade.
Right. But that's because globalization, technology, automation have just improved productivity so much. The things you buy, be they televisions or computers, they just get better and better for less money.
World's a little crazy right now.
Yeah, world's always going crazy.
Always.
So
anything you tell, I mean, I'm sure you get calls from clients about what's going on in the Middle East, and what do we do? I mean, is it simple, just don't touch anything, stay the course, or is there something more you can say to people to make them to take their emotions down?
My partner, Michael Batnick, makes these wonderful charts, reasons to sell. He did one from 2009 to last year, and then he did another one from 1926 to today. And the whole time, stock markets go from the lower left to the upper right. There's always a reason to sell. Hey, the Great Depression, World War I, World War II, just work your way through it. The 50s were an era when we were living under the threat of nuclear war. Hey, the apocalypse is coming. To quote the great Art Cashin, when the apocalypse comes, you want to be a buyer. Because if you're short, who's there to take the other side of your trade to settle?
And if
it doesn't happen,
who cares?
And right, he tells that wonderful story. So look, there's always, take a look at the chart that's in the slide deck I just showed. The oil embargo crisis, stagflation, malaise, Iran-Contra. There's just every year there's something else. And every year it's disproven. Even in the middle of COVID, when we were locked down and off 34%, if you were a buyer at the end of that quarter, the end of the year, you were up 68%, and the next year you were up 30%.
So don't change anything, basically.
I mean, if not only do you have to know the timing of these global events, you have to know the second and third order effects. How are these things going to affect markets? I used the example in the presentation of Russia invading Ukraine. Russia invades Ukraine, take a mic, go out on the streets and say, where's oil going to be at the end of the year? Much higher. Oil ends up lower at the end of the year. Even if you know what's going to happen, it's almost impossible to figure out second, third, fourth order effects. You just can't tell.
So you manage money for high net worth individuals. What do you tell to some people, some families, some individuals that are not high net worth? How do they get started? What do they do? I mean, you started somewhere, before you were high net worth.
We manage money across all four tiers.
Right.
We have a digital assisted human advisor called Good Advice that is no minimum. It's 50 basis points, and then we work with the next tier of wealth, and then the high net worth, and then the ultra high net worth. And it's the same conversation we have with everybody. If you're younger, we talk about the importance of savings and having a plan and being consistent over time. If you're older, we talk about checking all your boxes, making sure that you're paying the appropriate amount of taxes, no more, no less than you have to, about having a will, figuring out what you want to do with your money, and lastly, having purposeful capital. Money is just a tool, and it's useless if it just piles up and does nothing. So what do you want to use this money for? Are there philanthropies you want to support? Is this for generational wealth transfer?
Just retirement?
Your money has to have a purpose more than just accumulating in bigger numbers.
It's more of a psychological conversation.
It's all behavior.
A therapy session.
So I would modify that to say, you're one part quarterbacking the whole financial picture to make sure that no stone is left unturned. How do I make sure I don't pay estate taxes? How do I minimize my capital gains tax, especially if there's a sale of a business or employee stock or an inheritance or whatever it is. But a lot of it is also just thinking about what you're going to do to put this money to the greatest effect. Surprisingly, people who, or maybe not surprisingly, people who've spent their whole life working, savings, accumulating, they hit retirement age, whatever that might be, 60, 70, whatever they choose. Maybe and getting them to turn around and start spending money is hard because they've been trained their whole life to work and save, work and save. Hey, you're fine. You go take that vacation, take the family with you. You get plenty of money. Enjoy your life. The goal isn't to die with the most money. It's to have the nicest eulogy at the funeral.
And to enjoy your life.
That's right.
After you're done working.
That's right.
So you're not a fan of market timing?
No, I love market timing. I'm a giant fan in my cowboy account. I live for that. But with your real money, nobody really does it consistently well.
So I know there's some portfolios that you have for clients where there is a bit of a timing trigger in there. Can you talk about that?
So,
and it's a conservative timing.
Right. So we have
was it goalkeeper?
Goaltender is the purpose is really a behavioral hack. Because when the markets are getting shellacked and people call up and say, "What have you done?" Nothing. They don't want to hear that. They're going to lose their mind over that. So instead, we set up a portfolio. It has 3 primary holdings. The biggest one is the Qs and the S&P. And we use a number of simple rules-driven formulas to say when do you move out of equities and into bonds and when do you move back. And, put 10 or 15% or 20% of your portfolio in this. It's done about as well as a 60-40 portfolio should do, but the purpose is when the markets are falling, and let's say you're in a 70-30 stock and bond portfolio and you have 10 or 20% of this, suddenly now you're 50-50 or you're 60-40. And it's a minor change. The point is to prevent you from touching the big pile of capital. The cowboy trading account and goaltender.
So it's kind of a little cowboy goaltender.
They're all behavioral hacks.
How's that worked, the goaltender?
It's worked fine. It basically lets people feel like, all right, we're doing something. We're not just sitting here and getting shellacked. And that's satisfactory.
It's performed differently or better?
It's done about as well as the portfolio.
No difference.
It's not winning awards for outperforming. Right. It does about what the core portfolio does, which is what it's supposed to do.
And what was the a couple of recent times where it went to cash or where there was triggered to sell or to get out?
I don't want to give you dates because I don't know them off the top of my head. So it briefly went to cash in 2020. I mean, that first drop in February sent it. And then flipped back into stocks, about a month or two afterwards.
Okay.
After the bottom. So would it have been better off staying in stocks that whole time?
Probably.
Yes, but the remaining 80% of the portfolio, people didn't touch. And that's the purpose of that.
If I remember, I think you had went to some cash in 2002.
Well, it didn't exist in 2002, but in the back test.
Excuse me, 22. My fault.
In the back test, there were repeated times.
But I mean, in 22, after invasion of Ukraine,
right,
I think there was a bit of a drop.
That's correct.
So you manage emotions, you manage money. What do you tell people who come to you first? I mean, when somebody comes to you, where do you start? You start with just they're making sure they're saving money, they're putting money away. I mean, how do you get somebody to behave properly?
We look at their circumstances. We look at where they are, where they live, how much they're saving, ask them what they want to do with this money, create a plan around that, and then ask them, tell us about some financial wins you've had. Mm-hmm. Everybody loves to talk about, I owned Apple at 15. Oh, how long? I tripled my money. 45, split adjusted, that means you sold about $2. Yeah, I know that. So tell us about your wins, tell us about your losses, tell us about your mistakes. And you start hearing the pattern come up. The pattern. There's a crazy statistic. People who panic sell in a bear market, 30% of those people never go back to equities. So sometimes you start the conversation with, hey, I've been sitting in cash for 5 years. The market's been up 42%. I know, that's why we're talking to you. So you find out what their mistakes are. You try and put it into the context of,
learn from your mistakes.
Here's what markets do. Here's why that's a mistake. And by the way, 5 years from now, you're going to make that exact same mistake unless we prevent you from doing that. Because we're people, we're humans, we're emotions. It's not that, I love the Danny Kahneman quote. It's not that people are stupid. Investing is hard and we're emotional.
That's right. So emotions, there's market sentiment and I know you've spoken about contrary, indicators and contrary thinking. I mean, you talk about us being emotional, herd, behavior people. We need to feel with the group. Sometimes, you want to think differently than everybody else. You want to think outside the box. When is it a good time to be a contrary, to use contrary thinking or contrary sentiment and to follow the herd?
In the cowboy account, yes. Look, the problem with being a contrarian is twofold. Maybe even more. First, the crowd is right most of the time. Mm-hmm. Markets, news alert, are crowds. And for the most part, crowds are really good at assessing broadly what's most likely to happen. Crowds don't get it perfectly. They go too high at the top. They panic and sell too hard at the bottom. But that's how bottoms are made. Capitulation means surrender. Bottoms happen when there's nobody left to sell. Tops are harder to pick because it's the lack of, people slowly stop buying and it happens over time, whereas bottoms are just get me out. Right. It's an event as opposed to a gradual process. And so, look,
So in the cowboy account, when do you get contrary?
All right, so October 2022, I could tell all the advisors in the firm are starting to get nervous. We made a low in June 2022, and then all of my favorite, sentiment indicators and trading indicators all were like pretty far pinned.
What are your favorites?
It's a long list, and it's never the same group. Like, again, it's an art, not a craft.
What do you think of the Investors Intelligence Advisor sentiment? Is that something you look at?
There's the percentage exposure of individual investors to equities. Mm-hmm. And when that gets over 70%, you're topping out. But when it gets, I'm trying to remember the bottom range, if it was like 50 or 55%, I'm always knowledge adjacent. I pull it up on the computer. Right. There it is. But when it's like 48%, you just look at the chart, you'll see where it is.
It's the percent of investors in equities.
Exposure to equities. And that chart has, it doesn't give a lot of signals. Mm-hmm. Like it's given 5 signals over the past 30 years. That's great. On the other hand, sentiment is kind of hard to judge. When you ask people, are you bullish or bearish, what they're really telling you is what their last transaction was. They're bullish because they just bought something, not because they've thought about, I like the state of the economy for the next 10 years. It's, no, I just bought stock, so of course I'm bullish. And we've seen a lot of things affecting sentiment. Last summer, 2022, the sentiment readings were, I want someone to explain this to me, worse than the 87 crash, worse than the dot-com crash, worse than September 11th, worse than the financial crisis, worse than the COVID lockdown. Something's wrong with that. I've heard some complaints that you can't reach people anymore.
Right.
So you're just getting a bunch of older folks watching Scare TV, panicked on the home line. Wait, you're calling home lines? Who has home lines?
No, I don't
right?
know.
So that's number one. And number two, on the younger side of things, when we look at social media, they've all become a toxic cesspool.
Like the meme stock thing.
Yeah, so Twitter, Facebook.
So it's more of a
magnification. Even LinkedIn has become.
It's a magnification. It comes with the media need to just stir everybody up to keep their attention.
I put a post up recently that showed the emotional valence based on a study that the Harvard School of Neiman Labs School of Media Studies, the emotional valence of words in headlines. And you look back over the past 20 years and words like that connote anger or fear up 100, 150%. Neutral words, joy,
news,
down, way down. And so I think media is making us crazy.
Yep.
And this, by the way, includes both traditional media and online media. And then social media, it's a outrage generating machine, not good for our heads.
So in closing.
Delete your Facebook account, you'll be much happier.
In closing, the most important thing is, more so these days, is to manage your emotions.
Manage your behavior. Listen, manage what you can control. Mm-hmm. Hey, hold on, inflation's too high. Let me pull this lever down. You can't control inflation. You can't control what the Fed's going to do. You can't control what Biden or Trump are going to do. You can't control what the Israelis and the Middle East are going to do. You can't control any of that stuff. You can control the amount you're saving, the risk in your portfolio, how diversified you are, and your own behavior.
And who you might trust to give your money to or advise.
Do your homework. Check it before you hand money over to people. Do some due diligence. Look around. Read what they've written over 20 years. Speak to clients. Find out who they are and what they're about before you say, here's a lifetime of my money that I've accumulated.
Well, been great talking to you again, buddy.
Thanks so much, Jeff. Always great to see you.
Thanks, everybody.